thank you for coming back, everybody. We are on Unit 14 at the Agent Rising Real Estate School and Pre-Licensing course, which is real estate financing. So you all... Do you want to call her back? You all have done the financing with Elise, so I'm just going through, okay? So special note to the people who are watching this recording, this is just a review, okay? So it's not a comprehensive chapter through, okay?
How are you?
So many homes about with borrowed money. Okay, so our chapter objectives are to describe various aspects of housing affordability, including mortgage terms, ability to pay, and investment and tax considerations. Describe the terms, conditions, and use of a promissory note. Explain the elements and use of security judgments. And describe mortgage deed of trust and the roles, rights, and obligations of the parties involved. Describe the various types of real estate financing. Explain the distinction between a judicial foreclosure and a non-judicial foreclosure and the process involved in each. And describe the various consumer protections related to homeownership. I am not reading those. Okay, so those are the, you got me there. So anyways, housing affordability, the mortgage terms. So when you are meeting with, when your client is meeting, so in reality what happens is, and they probably talked about this, is when you have a client that says that they're interested in buying a house, you want to have, I call it the three-legged stool, where we're like one piece, the mortgage person's the other piece, and then the attorney's the other piece, okay? You kind of want to set the ball in motion and the actions in motion for all of those right off the bat, okay? So the first thing you want to do is you want them to connect with a mortgage person. And, you know, we have a couple, most every real estate company has a few people that they work with, you know, and often they will give out the names of a few. Now you met with Elise. Elise is somebody who we have a special relationship with. We think that she's, you know, a very strong professional, and so she's always seems to be one that, you know, that we work with a lot. But there are other good ones out there too, you know. So you want to make sure that you have, as a professional, you know, like Cape Cod 5, Jim Austin does a lot of land stuff, and he, you know, he's a good person to go with for that. Farming stuff. If you have any agricultural farming stuff, there's a farm credit in Middleborough that does some of those, and you know, there's different people that do different things. Reverse mortgages. There's some stuff out there for Brook Road Mortgage. They do a lot of reverse mortgages. So there's some specialization in the mortgage field for us to talk with, you know. Anyway, but they will also refer their people too. So like if you went to Elise and said, you know, my person has 61A, what, you know, and she says, well, we don't do those, here's who I would recommend, you know, so we have some communication that way. If you are in a situation where you have a bad experience with somebody or a mortgage person, and you have somebody else that comes in with one of their pre-approvals, you might want to have some mortgage counseling with them, you know, like it just kind of direct them to get some other people involved. You know, you can't tell that buyer who to work with, you know. However, if you've had some bad experiences, you know, you might want to, again, you never want to trash anybody in this industry, right? But you may want to kind of have them get some more, and you may want to, you know, enlighten them a little bit. Okay. So, so mortgage terms. They will go through what those different mortgage terms are, that will be appropriate for them. They also go through ownership expenses and ability to pay. And one of the things is they call PITI, which is principal, interest, taxes, and insurance, and then the debt to equity ratio. Now, with the new guidelines, and I don't believe that this will be on the test, but it's just for your information, they now have all of the expenses of that house, like how much the electric was, how much the, you know, all of the utilities were in the house, so that they are covered with it. Okay, and then investment consideration, tax deductions, and benefits. So there's a ton of benefits to owning a home, other than just you know, having a place to live. Okay. What did we say about condos? Condos have, I'm going to stand up because I can't see you all. Condos have Condos have a little bit less affordability, right? You can't afford as much condo as you can house because of the extra expenses, okay? Did you guys have any questions on that? Okay, I'm just kind of zipping through these. All right, the promissory note is a negotiable instrument. It has the interest in there, and usury, who knows what usury is?
Usually has to do with the limits to what they can charge people to borrow the money.
Is that what they, I don't know. So
I'm just guessing. It has something to do with the limits of the money they're borrowing.
Charging interest in excess of the maximum rate allowed by law.
Okay. All right, there's a loan origination fee. Now this is interesting when different mortgage companies charge their loan origination fee at different times. Okay, you know, one of the things that they had come out with was they wanted a person to go get 3 good faith estimates before they would commit to a mortgage. But in order to get that true good faith estimate from the mortgage company, you actually had to apply. So they would spend the $500 3 times over to get the best, you know, to get their best good faith estimate. So I think that they've modified that, you know, with this new regulations. Discount points. Who wants to tell me what discount points are? Go ahead, Rachel.
Stretching.
You were not stretching.
Okay.
Tell me what discount points are. I was stretching.
A point is 1% of the amount being borrowed.
Okay.
So they're used to increase the lender's yield or rate of return on its investment.
Right. So they're basically buying down their mortgage rate by paying 1% of the loan amount. So a lot of times people will pay 1 point or 2 points. So they're paying more money, you know, so that they can have a less of a mortgage and less of an interest rate on it. Yeah, closing, yeah. And a lot of times this is just a pay attentioner. On the test, they will throw the discount points into a lot of math questions. And it has nothing to do with it, okay? So they'll go like, okay, this person's borrowing X amount and there's, you know, 2%, they're doing 2 discount points. How much is the transferred tax stamps? And you'll be like, oh shit. You take the 2 points off. What is the 2 points again? And you go through this whole thing and you're like, you know, so they're trying to mess you up. So those discount points they throw in there, right? So really be firm on that when you're doing your math questions. Like pay attention to how you make it out on that. And then a prepayment penalty. Okay, that would be if you paid your mortgage ahead of time. And I was just gonna say, I don't think that Massachusetts allows those. Okay.
Except in commercial.
So this might be on the general part that they talk about prepayment penalty, but on the Massachusetts part, it would not be. Okay.
Not allowed.
Right. The Massachusetts says that you can pay it back when you. Okay. Why would there be a penalty for prepayment?
Because they want to make enough money
Right.
in your.
Does anybody know the year that it actually changes that you're paying less, like more down on your property and less on your interest? I think it's year 7. It's year 7. Up until 7, you're paying more interest than you are principal. So they like to hold on to that loan for at least that amount of time. But if you were interested in doing private financing with somebody, and they were going to pay you off when they had their credit, that's not such a bad deal, is it? Because they're paying. So if you were going to follow, if you said you would hold papers for somebody or do that private financing that we talked about, and you followed the same thing that they would get at the bank, right? And then they were going to refinance when they got their credit, right? That first 7 years is mostly interest. So when they refinanced it, it would be at that same rate. So you would be able to keep all that and still get your full principal when they refinanced. So it's kind of interesting. I wish I had a lot of money. I would do that. Okay. Maybe when colleges are done. Okay, security instrument, a mortgage loan, hypothecation. Who wants to tell me what hypothecation is? God bless you.
So there it is.
The debtor retains the right of possession and control of the secured property while the creditor receives an equitable right to the property.
Okay, so hypothecation. We talked about that before, about equitable title, right, and equitable ownership. States have, there's 2 different ways that they do it. And one is what they call equitable title, okay, where basically the buyer has the right to use the house, but they don't have the Yeah.
Right.
Right, so, we're kind of a blend, Massachusetts is a hybrid, okay? And then lien theory is what?
What we have here in Massachusetts.
We have a blend, but yeah, lien theory is that it's,
You have
Retains
title, what
both
we-
legal
Security
and
of the
equitable
debt.
title to the property that serves as security for a debt.
yeah, exactly, okay? Good stuff, huh? All right, so you guys, did you go through all of these things? You probably did. Duties of the borrower, provisions of default, assignment of the mortgage, release of the mortgage lien and deed of trust, the defeasance clause, satisfaction of the mortgage, tax and insurance reserves, and flood insurance reserves. Did you guys talk about all these things?
Mm-hmm.
Yeah, this is like her thing. This is her vibe, you know, when I've heard her. So, okay, so buying subject to or assuming a seller's mortgage or deed of trust. And then the alienation clause, what's the alienation clause?
The lender may want to prevent the future purchaser of a property from being able to assume the loan, particularly if the original interest rate is low. For this reason, most lenders include an alienation clause,
That it can't be assumed.
also
And-
known as resale clause.
I saw one house probably about 3 or 4 months ago, and the description saying, you can assume this mortgage. And so it was one of the things that they used as a selling point, because most of the time mortgages are not assumable. Okay, okay, types of loans, straight, interest only. Okay, so that would be, if you were to figure out, like, in our little brains, or my little brain, I should say, I'm not gonna, you know, how a mortgage would work with the interest, I would take, like, the interest and I would figure it out, and my brain would be able to do a straight line factoring, okay? Amortized means that it goes over time, each month, that your things come down, it's recalculated according to those numbers. Did she go through all of these with you?
Yep.
Yeah, okay. Yes, no? Not really?
Well, not in, I mean,
In depth.
not in depth.
Okay, so we'll cover that a little bit. Adjustable rate mortgage, we talked about those?
Mm-hmm.
Okay. So I just had somebody, okay, and this is what sometimes when you have somebody who's just, and they wanna like, they just go, I might do adjustable, I'm gonna wait on the rates, I'm not gonna lock in, and the rates are climbing up, because I think they gotta come down, and I'm going, who's talking to you? Like, who's giving you this advice? You know, because anyways, so one of the things you wanna do is, all of our interest rates right now are pretty awesome, okay, so it's you know, we're coming off of a ridiculously low interest rate, so, you know, try to get those people involved as soon as you can. Don't have them wait till things bump down again. You know, that is not the way that it's looking. That's not anything that we're hearing, you know. Okay, growing equity mortgage, balloon payment mortgage loan, that would be keeping it low or paying interest only and then having one balloon payment at the end. You know, conceivably when you sell the property or something like that. And then reverse mortgage, that's for the senior citizens. Okay, I'm just gonna give my little personal thing on reverse mortgages, is that on a reverse mortgage, you know, we've had several foreclosed properties due to a foreclosure, a reverse mortgage being taken out by the parents. That person, you know, passes away. Nobody wants the mortgage that they did. You try to sell it, the equity's not there, the fees are there. It's complicated. So talk to a professional if you're going to do any of those things. Okay, foreclosure. We talked about how the foreclosure process. When is a home in default?
Within 30 days of not paying them.
The day. It's in default the day after that payment was due. Okay? They don't start doing anything that day, but they have the right to. Okay? So we don't have 30 days to pay something. You know, it's the day after the due date. Okay? And that might be on the test. Okay, so this talks about some of the judicial, non-judicial. Who knows about the deed in lieu of foreclosure? The deed in lieu of foreclosure is basically, they call it cash for keys sometimes, or somebody's in default and they hand over their keys and they don't, well, it is a foreclosure, but they don't call, but the person doesn't go through all of the foreclosure proceedings, there's no auction on their house, the bank takes ownership of the house. Okay, so for a lot of people, it feels much better than actually having a foreclosure happen. One of your things that you will, if you're dealing with this kind of population is the things that the part of you as the real estate professional that's helping them, the things that they're worried about is their name being in the paper, that their friends are going to know at work, that they're late on their thing. There's a lot of different moving parts that make them that make them avoid handling these things. Okay, so one of the things that you can help them with is just breaking it down into step by step. Okay, and getting them in touch with the right professionals to help them. Okay. Consumer protections, the Dodd-Frank Act, homeowners insurance, coverage and claims, comprehensive loss underwriting exchange, and federal flood insurance program. Did you guys talk about these? Yeah, good. All right, so we'll do a couple quick questions. Did you guys do questions? You did. I think I heard you doing questions with you, right? Okay, so we're just going to click right over to Unit 15. Okay? Sound like a plan?
Yep.
Okay. So government involvement in real estate financing.
So we're in Mass?
Nope, we're not. We're still in yellow.
Oh, okay. Sorry.
Yeah, I think that's a good question because I normally do flip-flop through them. They don't match up exactly. There's more yellow chapters than there are state chapters. So a mortgage that has no direct federal involvement, even though it may be federally chartered lender, is called a conventional loan. Loans that have direct federal involvement include those insured by Federal Fair Housing Administration, FHA, or guaranteed by the U.S. Department of Veteran Affairs. Okay, so did you guys get the differentiation on this? Okay, so anything that has some federal involvement has some FHA involvement or the veterans involvement. Okay, those loans tend to have the best rates. Okay, the gist of it is that they have the house stricter guidelines on the house passing inspection. Remember I told you the people have to qualify and the home has to qualify. These are a little bit tougher than a conventional loan. Conventional loans often have a little bit more to put down, and so that's another reason why they're not as affordable. Okay. And then the chapter objectives was to, I'm sure she did that with you. Okay, we're going to skip those. Okay, so introduction to the real estate financing market. The government influences the primary mortgage market and the secondary mortgage market. All right, the Fed regulates the flow of money and interest rates in the marketplace through its member banks by controlling the rate charged for loans to make to the banks called discount rates, as well as their reserve requirements, the minimum level of funds that a bank must maintain. Okay. The primary mortgage market, okay, lenders make money directly to borrowers. Okay, those could be savings associations, commercial banks, insurance companies, credit unions, pension funds, endowment funds, investment groups, mortgage banking companies, and mortgage brokers. Okay, so you deal directly with the lenders on these. The secondary mortgage market, those are the ones, the loans are bought and sold only after they have been funded. And those, the big buyout that we had when the mortgages crashed, most of the money went to the secondary market. So we did not directly see that money that was infused into the system. Okay, it was more on this market. And it was what they call the government-sponsored enterprises. Okay, so now the government has more hand involved, and that's what they call the bailout, right? So Fannie Mae, Freddie Mac, Farmer Mac, and Ginnie Mae. They will ask questions. They'll mess with you on these. Okay, so know that these are the secondary markets. Okay, that's a memorization thing. But they'll say to you, something about like, did you get a loan from, Freddie Mac or something? Or which one of these did you not get a loan from? Or some sort of something like that. They try to confuse you on these. But you guys aren't going to be confused, right? Okay, so loan programs conventional, it's an 80% loan to value. Private mortgage insurance is greater than the 80% loan to value. Okay, FHA insured loans. Did she say that all FHA loans have PMI now? Okay, so I'm trying to remember what the new ruling was. I think it's that the FHA loans that have PMI is for the life of the loan. So when you take out an FHA, right, now, is that when it gets to 80%, you don't get to stop paying, you don't get to stop paying your PMI. It's for the life of the loan. So there's been some pushback on that. So I imagine that there might be some changes in that as we go forward. But you know, they're trying to figure out ways. I mean, they offer the money the cheapest. They ask for a little bit down. They do all these things. So this was one of the things that they put in to make some money on it. The second thing is that, when people talk about foreclosures, and where does like they're like, oh, the poor bank, like the bank, you know, they defaulted on their loan. So I've told you that, you know, for the first 7 years anyways, they've got the interest mostly on that payment. They take over the home at the foreclosure proceedings. They collect their PMI, or they collect their mortgage insurance, so they get their mortgage insurance on the property, so they collect their insurance on that house, and then they have the house to sell. So banks are not losing out, okay? Banks never do.
Isn't that only if there is PMI though on it?
Yeah, well, they have to have, but most bank, I mean, I think most mortgages that have been foreclosed on have mortgage insurance. Yeah, I do. I think that actually, if you followed that and studied that, you'd see like when the bank doesn't foreclose on something and they leave it there or whatever, they languish on it, you know. Most of the time, I think that there is a PMI involved. Okay, so the VA, the guaranteed loans. So if you have a veteran, now it's illegal to discriminate because somebody wants to use a VA loan. Okay, it's illegal. So that will be a question on the test. Okay, it's the certificate of reasonable value, the cost, prepayment privileges, and assumption rules. Okay, they have, the VA loan is considered like the best loan for a person if they can get it. And a veteran can get one VA loan. Okay, I believe, although there might be some exceptions to that. And the reason why a lot of times sellers don't want the person to be using a VA loan is there's a lot of hoops to jump through. You know, that qualifying the house is a lot more difficult. Okay, but I think it's no money down. Okay, agricultural loan programs around here, we call them USDA loans. Okay, many of the areas around here qualify for those. Okay, and again, it's interesting. It's a great program. Sometimes they run out of money, like right in the middle of it. You know, so it's been challenging at times for them, but they are good loans. They take a little bit longer. Okay, and I know she goes through all of these with you, and she says all the ones that you don't do anymore, right? But so those are other financing techniques. I've seen package loan, blanket loan, and wraparound loan as some of the questions that are involved in the questions. Tomorrow we're having a panel of people who have recently taken the test to tell you what they found on the test and the surprises on the test. So that will be like as part of tomorrow. And also a couple people who are working different places and like, you know, how they decided what they were doing. So we will have a little bit of onboarding for you guys as far as that goes. That'll be a little bit more fun than me. Sorry, it's so boring. Okay, so Truth in Lending Act is the Tyler, and the Regulation Z. Equal Credit Opportunity Act, Community Reinvestment Act of 1977, RESPA Real Estate Settlement and Procedures Act, Computerized Loan Origination, and Automated Underwriting and Scoring. So I'm sure at least went through those things with you. Okay, so any questions on that? When she left and when you were going over your notes, you guys didn't really get a chance to go over your notes yet, right? Okay, so if you have any, I will have tomorrow. There'll be some time that if you want to just talk about them, we will. Okay, and I'm just going to do the chapter that goes with this. All right, and then we'll have lunch, okay? So right now it's like 10 of 11, or 10 of 12. So we'll have lunch after this, okay? And we'll just get excited. We'll make sure that, listen, when we break for lunch, you are all mandated to go outside, okay? I left here the other day and I'm like, what the? I said, I haven't even been outside once today, okay? So let's go outside, get some fresh air, do a couple laps around the property. Maybe we'll hide some Easter eggs out there, Marie, for them to find.
You know, it's the two other, like, they're not quite hot yet, so take your time.
Okay.
Just kidding. There you are, Andre. Another much shorter and the other one takes a little bit longer.
Yeah, because
It's not the Ninja.
well, last year we had at this office Pilates and soup, so we'd have for lunch, we called it lunch and lean. And so I bought the Ninja to do the soup so that so the person who taught the class would come and throw a soup in, would take class, and then 45 minutes later would finish up with soup. So it's like this amazing crock pot, you know. And then we have like the usual crock pots that are supposed to take all day, and so we're not having the same kind of success with those.
Thank you, hours.
Then what happened was we're like, okay, let's just skip the Pilates and let's just eat. Okay, so
What chapter is
this is chapter 11, financing. Massachusetts is a title theory state, meaning that the mortgage splits title to the property. The mortgagee takes legal title, while equitable title is retained by the mortgager. Okay, so we've now said this 4 times. The granting of the property to the mortgagee by the mortgager is done with an instrument that is similar to a warranty deed, except that the document contains provisions permitting the mortgager to get the property back if he fulfills certain conditions. Generally, these conditions are pays back the sum of money with interest as provided by the separate promissory note, keeps the property insured for the benefit of the mortgagee, promptly pays the taxes assessed against the property, keeps the property in good repair. And again, the way that they say that is does not allow waste, and does not remove any buildings or improvements from the property. Okay. The mortgage discharge, MGL, Chapter 183, 54, and 55, and also Chapter 63 in the Acts of 2006. Within 45 days of receiving full payoff funds, the mortgagee must record an effective discharge, which includes recording or providing any necessary documentation, including assignments to make the discharge effective. Documentary proof is needed to establish the authority of a server or note holder to discharge a mortgage. Okay, so just as a note, when you are getting ready, if you have a house that they say they've paid off their mortgage, you want to jump on the registry and see that the discharge has been recorded. Many times they're not. Okay, and they have to be recorded. So you want to make sure that you as the professional would catch that and say, because the mortgage guy who's the mortgage, they tell me not to call them mortgage guys anymore. Mortgage professional, it's when they hire when the mortgage company hires the attorney and they do the title work, and it's like 2 weeks before the closing or 1 week before the closing is by the time that comes as that piece of the puzzle, is that if there's no discharge there, they have to go and track it down in the bank, and it could take some time, and you need an extension where you can take a peek at it, at any time and see that it's discharged. And you don't have to know for sure, but if you saw that it's not, you can say to the attorney that's the closing attorney, can you do me a favor and just check? I looked online, and they think you're really smart when you do this. I looked online, and I saw that there's no discharge recorded. Could you do that for me? Okay? And what they will do is they will go back and they will check their stuff. And it can help avoid that. Okay? Financing techniques. Massachusetts banks are permitted to make purchase, participate in, or service a wide variety of statutorily approved real estate mortgage loans, including certain loans in excess of 95% of the value, open-end mortgages, and reverse mortgage loans. In Mass, several state agencies provide financing and loan programs for homeowners and renters. Okay, so mass housing is a huge one, and I think Elisa's an expert on that, right? Mm-hmm. Yeah, so Elisa's a huge mass housing person. And then Massachusetts Housing Partnership Fund and Massachusetts Department of Housing and Community Development. So Massachusetts has a lot of great programs. If you have somebody who wants to be a first-time home buyer, if they take a class by Mass Housing, they get a portion of their deposit covered by Mass Housing, or they get does anyone know how much money it is? $2,000 or something? Mm-hmm. They get a little certificate that they went to class, and then they provide it, and they get some money off. So it's a great program for them. It also gives them some counseling on what to do if they can't pay their mortgage, or what it means to not pay their mortgage on time. Okay, so it's a very I think it's a very awesome thing. Also, if you guys are in the New Bedford, Greater New Bedford and New Bedford have some nice initiatives also for communities. And as with other cities, so if you're, find out what the local cities and municipalities offer for programs, because there's a lot of money that could be out there. Okay. Predatory lending. Did she cover other predatory lending? All right, let's just talk about predatory lending, for example. Here are some examples of predatory lending. Using false appraisals to sell properties for much more than they are worth. Encouraging, okay, so we saw a lot of this when they were doing refinances before the crash. So they used to be like, there'd be mortgage companies out there that would hire appraisers that would appraise it at a higher price, or they, what we call like drive-bys. They would drive by the house and that would be what they'd use for their appraisal. And it was not significant, and it ended up being that they, you know, $400,000 house would have a $100,000 mortgage on it, you know, and then when they, you know, went to sell it, they could not, you know. Engaging borrowers to lie about their income, expenses, or cash available for down payments to get a loan. Again, that's very difficult to do now. I mean, any deposit in your bank account over, is it $3,000? I think it's $3,000 needs to have an explanation, you know, so where it came from and they have a history with it. So, for example, say you were going to get ready to, you or your buyer was getting ready to purchase a property and you got, you know, $5,000 from your folks. So they would then go and they would want to see where that money came from and where that money came from for them. You know what I mean? So it's and if it's a gift, they need a gift letter and, you know, all that kind of stuff. So that, you know, they will age. Sometimes if you have it in there and you don't have a source for it, you have to age it. You know, for like us realtors, we get commissions. So our commissions would be over on a lot of those, and they'd be like, how do you explain that? I've had to write a lot of letters saying that money was was a commission. Knowingly lend more money than a borrower can afford to repay. Okay, one of the things that will best, you know, build your profession is when you're talking with people is really, you know, if they're pre-approved for something and they're not comfortable with that number, is really try to keep them in a house that's affordable for them and that they don't become house poor. Changing high interest rates to borrowers based not on credit history but on the race and the national origin. Yeah, I feel like saying no duh. Charging fees for unnecessary and non-existing products and services. Again, a lot of the things that we do now really make these things, you know, obsolete. Pressuring borrowers to accept high-risk loans such as balloon loans, interest-only payments, and steep repayment penalties. One of the big things that happened in that when we had that crash was that they would put people into adjustable rate mortgages, and then when it came time to lock in, the house was no longer worth the value of what the mortgage amount was that they owed. So it just happened that was, you know, when they did it, they probably were not trying to be predatory, you know, but that's how it ended up being. Targeting vulnerable borrowers when they know borrowers are in need of cash due to medical, unemployment, or debt problems. Convincing homeowners to refinance again and again when there is no benefit to the borrower, therefore stripping homeowners of equity in their homes. And using high-pressure sale tactics to sell home improvements and then financing them at high interest rates. Okay, so these are all things that are predatory lending. Okay, licensing of mass mortgage companies and loan originators. Okay, they have regulations, and it's implementing regulations over here. So they have a mortgage broker license, a mortgage broker license branch, mortgage lender license, and then they branch, mortgage loan originator license, and professional requirements. And I honestly don't even know the difference between what they do. That's why I call them mortgage guys. But is that they all have different kinds of things on that. Amortized loans in Massachusetts, amortized mortgage loans are called direct reduction loans. The payments on a direct reduction loan are the same amount each month. Each payment pays some of the interest on the loan and some of the principal. Initially, most of the payment is credited to the interest and very little is credited to the principal. Eventually, payment increases toward the principal and decreases toward the interest. And that's what I was talking about before. Okay, default occurs when any condition of the mortgage is not satisfied by the mortgagor. A default will activate the acceleration clause in the mortgage and cause the entire debt to be due immediately. In Massachusetts mortgages, the mortgage will have included a power of sale clause giving it full right to immediately possess the property, to advertise the property as having been foreclosed, and after a stated period to sell the property and apply the proceeds to the unpaid balance of the loan. Massachusetts has undergone many changes in its foreclosure laws. So, as I'm reading this, I mean, I've always believed that the process takes about 6 months from the time that a person defaults. Actually, from the time that a person defaults, I thought it was about 6 months from the time that you get your first notice. From the time that they say, you know, the first thing that they do is they would send you what they call a servicemen's and something act, where they, you know, because you can't foreclose on somebody who's in the force, in the service. So they send something out just saying that, and they record that, and then from there, that's when the process starts. And it has to be advertised 3 times in the paper and a couple of other goody things, but I'm not positive. Right to cure a mortgage default. In November 27, the governor signed into law an act protecting and preserving homeownership, which provided homeowners that were facing foreclosure a 90-day right, okay, so here we go. A 90-day right to cure the default after written notice was given, and then the 90-day right to cure applied once in a 5-year period regardless of the mortgage holder. The law was amended in 2010 to provide a 150-day right to cure. Okay, so the lenders cannot accelerate or foreclose on the property during the 150 days. So is that about 6 months? 6 times 3 is 180, so close. The 150-day right to cure is granted to the borrower once during any 3-year period regardless of the mortgage holder. If the homeowner remains in default, then the power of sale clause is activated. Okay, and I do believe that some of this will be on the test. Okay, did Elise go through this all with you? Okay. In accordance with Mass General Law 24, subsection 35A, the mortgagee may send a 90-day right to cure notice provided the mortgage can demonstrate that it's negotiated in good faith with the borrower. The mortgagee certifies that it has negotiated to reach an alternative to foreclosure in good faith with the borrower. So there's 2 things out there right now, HARP and HAMP. Okay, HARP is, I think, home. Does anyone in the back know? One of them is modifying your mortgage, and one of them is rewriting your mortgage, I think. I think one of them.
HARP is refinancing.
Okay, so HARP is, I think, refinancing the mortgage. So they take it and they actually refinance the mortgage. They may add on, like if you've paid, like say 7 or 8 years or 10 years on it, and you're struggling, they break it out to another 30 years. Okay, so they take the same loan debt, but they give you 30 years so that and sometimes they will take it and they will just add payments onto the end. So there's different things that they will do, and that's actually the first step in getting the curing, is that you have some sort of mitigation system in place. One meeting, at least one meeting has taken place between the mortgagee and the borrower. A mortgagee provides loss mitigation information prior to the meeting, and that after the meeting, the creditor is able to demonstrate that the mortgagee and the borrower were not able to reach a resolution other than foreclosure.
Kate, can I ask you a question on that?
Yes.
Do you think that the questions in, on the exam are more relative to like the content of what curing a mortgage default, or like referencing the actual law? What do you think they usually do?
In this case, I would say it's probably going to be a couple of questions. Because you think about it, there's, you know, they're gonna ask you the question that shows that you have an understanding of it. You know, and some of the questions in the back will really be helpful on it to show you kind of what it is. I mean, this book is, to me, the clearest reflection of what person does. You know, so if you're like flying through these questions no problem, then you probably will be fine. You know, but I do think that, you know, I don't think they're gonna like go to like 150 days versus 120 days versus 50 days. I don't think that's it. But they want to know that you've gone through the steps, you know, and kind of understand the concept. You know, okay, so this is back to this Serviceman Civil Relief Act. That was what I was talking about. Like this piece right here will probably be a question. You know, there are non-judicial foreclosure process where the lender only has to put the borrower on notice to the default payments as provided to the 90-day right to cure the default. Okay, so they don't have to go and have some states use a judicial foreclosure in which it requires the lender to file a foreclosure action in the court system. We do not need to go to the court system. Okay, again, the first step that you see is the serviceman. That's the first, when you're out there, that's the first thing that I look for. If someone says that they're not paying their mortgage, or they think they may be in default, the first thing I go is I look at the registry and I look to see if this has been recorded. Okay, if it has not been recorded, I know we have a little bit of time. Okay, actually, if it has not been recorded that I can see, I then ask. I'll go ask and say, can you check this for me, to see if it's something that I can't find. Okay, other provisions in the act protecting, preserving homeownership. Okay, the foreclosure notices are now required to be filed with the Division of Banks for better tracking. Licensing of all mortgage loan originators is required. Counseling is mandatory for first-time home buyers, as I was saying about like the mass housing. $2 million worth of grants must be extended to establish 11 foreclosure education centers in the Commonwealth. Okay, so they probably already have, well, that was 2007, so, you know. Assignment of loans. Lenders or holders of mortgages of deeds of trust often assign mortgages or deeds to other lenders or third parties. When this is done, the assignee, the person receiving the assignment, steps into the place of the original lender or assignee. An assignment is a legal document confirming that a mortgage loan has been transferred from one lender to another. Almost, for many situations, almost as you have left the building, they've reassigned your mortgage to somebody else. You know, very few banks keep the mortgages these days. Yes?
Katie, I'm sorry to jump back, but we were just talking about something here. We have a question on the Servicemen's Civil Relief Act. That gives them a little more protection before the foreclosure goes in?
No, it's when a bank is getting ready to foreclose, they have to notify them in case they notify everybody with this act. And what that act says is that if you are a serviceman, they cannot foreclose on you. So
But isn't that something that is happening? They are foreclosing on their homes and.
no, I don't think so. On servicemen?
There was,
Yeah.
there was
Oh, I don't know.
a huge complaint
Article
about that,
complaint.
that they're fighting for the country and losing their houses at home. There was something about
Interesting.
that. Yeah, that's why I'm a little confused about
Ah.
that.
Well, it wasn't in Soap Opera Digest. Okay, just saying. It has not happened to my people on the shows.
Oh my
I wonder
God.
if it has to meet the same criteria as the veterans, like must have served a certain amount of time, must have had on a
Maybe,
card.
but you know what, honestly, I don't know. My guess, if I had to guess, is that the mortgage is not in their name, it's like probably in their wife's name or something, and they're not doing the whole package. You know, would be what my guess
Part
is.
of it, yeah.
That would be my bet, because this has been, like, this goes out to everybody. Like, everybody who's gonna get foreclosed on, this is one of the first steps that happens. This, to me, is the first visual thing that I can see in the steps to foreclosure.
Or is
Okay.
this a mass?
No, it's not mass, I think it's federal. You can't, you know, so anyway. Yeah, so back on track. I honestly don't know the exact, like, steps of it, but I do know that they have to be notified. Another thing I'm wondering is it's when they come back, I don't know. As I say, it hasn't happened to Ridge up on the Beautiful yet, so I don't know. All right. I'm sorry, I just don't know the answer.
That's okay.
New requirement that the mortgage assignments be recorded. Okay, effective November 2012. House Bill 4323 substantially rewrote Mass General Laws 244-14 and 35A that added entirely two new sections, 34B and 35C. These changes added significant procedural hurdles to foreclosing on real property in Massachusetts. Under the new 14, a foreclosure may not proceed unless the entire chain of mortgage assignments from the original mortgagee to the foreclosing entity is recorded. Previously, the foreclosing entity had to possess, but did not have to record, mortgage assignments before foreclosing. Under the new law, no foreclosure notice is valid unless, okay, I'm going to go on to the next page, but I talked about this a little bit the other day. When they were doing a lot of refinancing, and it was like the recording things, and there was a number that was assigned to like a mortgage. It was the MER, I think it's CS, the MERX number. And what it was it was an electronic number that they would just reference. And what happened was they lost them. Like, you know, like countrywide mortgages that you heard, like other things, is that they were not able to be found. So what would happen is that they could not create that chain of title. So when I was telling you before, like someone bought a house and the title insurance and it was not foreclosed on properly, a lot of them had this, like this was what happened to them. And so they had to go back and re-foreclose. Okay, so I don't know what mine said. Actually, I can find out. I'm going to tell you, I think what it says is no foreclosure notice will be valid unless it's been foreclosed on properly. Okay, so and then deed in lieu of foreclosure. I want you to know that this is considered a foreclosure. Like, it has the same foreclosure guidelines, like this, like they normally say a short sale is like, a short sale is when you owe more on a property than you can sell it for. And so we ask the bank if they will sell it short, which means that they will accept a lesser amount than the amount that they have mortgaged, okay? And they sell it through, they talked about it before, it's called a short sale, okay? A foreclosure is when the bank takes back over the home, okay? So they say like short sales bruise your credit, and foreclosures, hurt your credit, break your credit. And the idea is, I think they say that a short sale is like 18 months to 2 years before you could possibly buy again, whereas a foreclosure would be probably, I think, like 7 years. Those are older numbers. I haven't really checked those in like the last, probably year or so. I'm just telling you that because a deed in lieu of foreclosure, which is that the bank says they'll just take your house over, take the keys, and you're done, right? It's still considered a foreclosure, all right? You just don't have to get it recorded 3 times. You don't have to have your name in the paper. You don't have to jump through all of those hurdles. But the gist of it is that the bank is taking it over. Okay, it's not being sold to somebody else. Okay. Okay. This right. A lender will not accept a deed in lieu of foreclosure if there's a second mortgage on the house. We didn't talk about second mortgages with us all, and it's not something that you need to know today. Just know that one of the big problems in the foreclosure issues was that the first mortgages and second mortgages. Oh, thank God. We made it. We made it. Okay, so this is the quizzes. Let's just do a couple questions here. Massachusetts is a lien theory state, an intermediate theory state, a title theory state, a warranty deed state. C. When a person in Massachusetts purchases a property, the title is split between the mortgage, who takes legal title of the property, and the mortgagor, who takes equitable title. Okay, one more question. The granting of property to a mortgage by the mortgagors is accomplished through the document similar to a quitclaim deed, a warranty deed, a defeasance clause, or a title registration.
B.
B. Good job, guys.